Trump tariff tantrum. That's the name of the show. We're talking to you on Friday evening, and we're talking to you at a time when it appears that there is a 90-day window which the US administration has agreed to countries where so far the tariff retaliation has not happened. We're also staring at a world where we've seen extreme volatility in the equity market, commodity market, and the bond market. You can argue back and say that India may emerge in a better positioning, but how does one go about investing in this market, in this uncertain time? They say volatility is long-term investors' best friend. So is this the volatility you should use to your advantage, or this is a volatility which could be an indicator of more trouble which is coming? Should one raise cash levels or use the bargain in the market, more like a annual Amazon sale, to buy what you always wanted to buy? Is it time to correct your mistakes which you did in COVID, which is that the laws of remaining fully invested, the laws of buying fear? So what is the best way to approach this market? Let's take that conversation forward with Mahesh Nandurkar of Jefferies. Mahesh, with each passing day तो बहुत लंबा है, with each passing hour भी बहुत लंबा है, with each passing minute now, financial markets are changing. How does one go about investing in this kind of a market where with each passing minute, a new dimension is getting added?
Yeah, very true, Nikunj. Thank you for having me on your show. The markets have become extremely unpredictable, as you mentioned, and that is because of some very high frequency announcements coming in from the US and the developments that are happening globally, which are actually beyond the control of most of the investors. So I think clearly the volatility has gone up, the risk levels have gone up, and so to that extent, I would say it's not a market where one can take a very adventurous call. One needs to sort of take a more measured approach, take a little bit of a cautious approach as well, evaluate the stocks and sectors more on their merit in terms of what the valuation is, what is the market expecting, and I would say basically take a slightly cautious approach. If it goes up too much from here, the market goes sort of too much from here, maybe book profits and buy only when you see some dips. But that too, I would say, in sectors where there are predictability, in sectors where there is valuation comfort, and in sectors, in my view, which are more domestically oriented rather than the global or the outward-looking businesses. So that's a very broad level philosophy that I would like to start with.
So Mahesh, you are of the view that don't panic but be careful, if I can put the thoughts here.
Yeah, I don't think we really need to panic, as such, in the sense that, while the announcements are like high frequency and high value announcement coming in from the US, and we have seen what Mr. Trump has been capable of doing. We've seen what the worst level it can go up to with levying a very high level of tariffs, and right now we have seen a 3-month pause as well. So I think it's not. I don't want to panic at this point in time, especially if I'm looking at Indian equities, or like Asian equities as such. Because the way I look at it is that announcements are coming from the US, and Mr. Trump is a businessman himself, and it's unlikely that the decisions that will sustain over the 6-month, 1-year, 2-year period are going to be sort of a hugely negative from the business standpoint. So there would be some rhetorics, there would be some threats. And those threats or those rhetorics are being used to negotiate, as we've seen already. And my sense is that that will be the approach going forward as well, in my view. If the market reacts to specific announcements in a very, very negative way, there is a good chance that some of those announcements will get rolled back, as we've seen.
Mahesh, how much of the bad news is in the price? I mean, it's important for us to look at that, okay, how much of this entire tariff adjustment to global trade and global GDP is something what markets have already factored in?
I think, to my mind, that to a large extent, those risks, have been factored in. In terms of the sentiments, obviously, what is not factored in at this point in time is the impact that these tariff adjustments are going to have on the US, in my view, and what kind of a slowdown that will be seen in the US or maybe seen in China, because those are the two economies that seem to get impacted the most, because each is levying like more than 100% tariffs on each other, right? Basically, the situation at this point in time is that the trade between US and China has come to a standstill. And maybe, as I mentioned earlier, things will improve from here on. And maybe a deal gets struck between the two economies at some point in time. And the tariffs that we're talking about are no longer 100% plus, but maybe half of that or even like a quarter of that. So maybe we end up at a situation, maybe it's 15%, 20%, 25% between the two large economies. So much better than what it is today, but still a 20% or a 25% tariff between, let's say, US and China is still very large in my view. And so to that extent, it will have repercussions on global growth and repercussion on global equities market. So that's obviously a big negative. But what I would also say at the margin is that one economy or one market, which is US market, which has accounted for large part of the flows and has accounted for, if you just see the maths, US equity markets as a percentage of global equity markets was at 40% back in 2010. That number went up to almost as much as 70% a few months back. So American markets, or the US markets, accounted for almost 70% of the global markets. So that is just the sheer outperformance that the US markets have seen. And now we have retraced from that level down to like 64, 60, 5% or so, or maybe a few percentage point lower than that. But remember, it is still much higher than 40% that it used to be. So my sense is that given the uncertainties around the policies from the US has gone up so much, I believe that US is no longer the most favored destination in terms of incremental flows going forward. And money will be finding its way into non-US assets. For the last few months, barring the last few days, it was Europe and China. But given this tariff war, even Chinese markets have also corrected. So I think non-US markets, non-dollar assets are going to see a positive inflow, and India will get its own share as well. So on a relative basis, I would say it is easier to make a call that Indian market should do better as compared to their other global counterparts. But that could mean that India falls less as compared to the rest of the world. It is not very easy to say that whether Indian markets will rally big time from here on. That's a very difficult statement to make. But so it's a relatively easier, I would say, decision for a global investor as to which markets to own. I would definitely say India is looking far better than many other markets globally. One of the factors that I would say is just the factor, which is oil. So oil prices have come down by almost $15 to $20 from their recent highs. And every $10 decrease in oil prices saves Indian economy $16 billion or nearly 40 basis points of GDP. And we are down almost $15 to $20 on oil prices. So it's almost 60 to 70 basis points of GDP. So whether that reduction in oil prices is passed on to the consumers or whether the government actually levies incremental taxes on it, but that doesn't matter. The economy is getting that much of inflow. Whether the government keeps it or it's passed on to the consumer, that doesn't matter. But that's overall a positive for the Indian economy as such. And so to that extent, I would say the negative impact of the global slowdown or the tariffs can get offset by just this one factor, the lower oil prices. So therefore, I would say that on the relative terms, Indian markets look better. And within the market, I would definitely look at the domestic plays, such as banks or some of the select industrial verticals and so on. That's what I would say at this point in time.
Mahesh, are we in for a earning season where markets are unlikely to get any cues because companies don't know what is coming next? And if that is the situation, do you think Q1 earning season is going to be nothing short of a, I won't use the word disaster, nothing short of a non-committal? And if that is the case, then do you think that could create more uncertainty and pressure on stock prices?
Yeah, I think uncertainties have gone up for sure, and we were actually expecting March quarter to be a better quarter than December. And by the way, December quarter was better than September. So September 2024 was the worst quarter in terms of corporate performance. December quarter was better. March should be better than December in my view, but that could also be because of the fact that ahead of these expected tariff decisions, a lot of Indian exporters actually exported in large bulks in the March quarter, so as to kind of overcome the 2nd April announcements in advance. And our discussions with a lot of exporting sectors shows that they have already pumped in goods worth 40 to 60 days, some cases even 90 days of inventory already. So to that extent, they have bought some time that the negotiators, at the government level, India and the US, probably, would be able to sort something out over the next, few months. And this 3-month pause that we have seen actually gets extended to several other countries, which would be able to kind of, come up with a reasonably, good deal on a bilateral basis. I definitely am very, very hopeful that India will be one of those countries, as such. So my base case here is that some of the exporters have already, sold enough quantities during the March quarter, um, and possibility that a deal will get struck by the time this 3-month window expires, and things will begin to be, more or less back on track, as such, maybe with a small negative impact. Also, Nikunj, keep in mind that last year, June quarter, as well as September quarter, had a low base. So on a year-on-year basis, the June quarter numbers, the September quarter numbers from the corporates, will be, reasonably good because of the low base also. So my sense is that I'm not that pessimistic about the corporate results. Actually, I would say that I'm not that pessimistic from the economic outlook perspective. But what one needs to watch out for is the P multiples, because those are still at an elevated level and could see some corrections.
Mahesh, so if a tariff structure for China and rest of the world is lower than what we currently know, 26% for India, crazy number for China, next 90 days, if negotiations hint towards a a level which is much lower than what the currently talked about levels are, could that generate upside in the market, or markets are already factoring in some step down?
I think markets already factoring in some step down because these kinds of numbers like 26% on India and much higher number for many other markets, these appear to be just the starting point. And in fact, the US president also made it very clear that this is like the ceiling in terms of the tariffs. And on the basis of negotiations, those numbers will be coming down. And some of these numbers are ridiculously high. I mean, if you look at some of the smaller countries like like Vietnam or Cambodia or Laos, then and if you make a mathematical calculation of the proposed incremental tariffs that the US government is levying, and if you just do a simple calculation, then those tariffs itself as a percentage of GDP for those countries works out to like 14 to 15%. I mean, that's a ridiculously high number. That incremental tariffs levied by US is like 15% of that country's GDP. That's clearly not going to sustain, right? So my sense is that the base case is that tariff levels on most of the countries, and including India, will settle at a much lower level than what have or what were proposed on the 2nd of April. It could be 10%. It could be maybe slightly higher than that. It could be slightly lower than that as well. In my view, and so to that extent, things will definitely become better. But as I said, what remains to be seen from the global trade perspective is what happens between US and China, because those are the two of the biggest trading partners as such. So yeah, to answer your question, Nikunj, that the trade tariffs actually go down even after those 3 months. there would, there's a good chance that there will be, some upside. And as I mentioned, I'm not that much worried on the EPS growth, or I'm not that much worried on the GDP growth. But what I'm worried about is the P multiples that we are attributing.